Today I'm at our Coralville, Iowa City branch. So here in this branch, we have office, but we don't have the studio like we do in Des Moines, Iowa. That's why you are seeing me sitting right here where my desk is. This is my office. And surrounding me are the other office buildings around. And here in this corner, we have about 5 to 6 professional staff here in the office. So this is this branch is our second branch, opened up long time ago. Don't make me think of how long ago because you make me feel like I'm really old. Today, it is sort of related to the last Tuesday we were talking about. And if you recall, last Tuesday we were talking about loan money from the business. When you loan money from business, out of that talk, and you know that my idea to you is we need to have a proper document together and to decide on a affordable federal rate, right? That the rate AFR rate. Use that rate. Above that rate, you set up a agreement. Then you can borrow money and you can pay the interest to the company. Then the company would have an interest income, right? So today, just related to that topic, and we have a couple of clients and just set that in. What about interest income? Is it taxable, not taxable? How can I make them not taxable? So these are the questions that come in. I know it is very vaguely defined, right? Because on last Tuesday, we talked about interest income. We were talking about the income that goes to the corporation from your personal account to your corporation, to your business. But if in your personal account, if you have Schedule C or Schedule E, you may be able to deduct the interest expense because you paid to the business. But today we're going to come around, look at your 1040 and think about interest income. If the interest income is made to your business, you know that is just other income, not your business income, because it's not exactly how you make money. You're producing wages, so interest income is your other income. And nowadays, with the interest rate going high, I want to remind you in when you come to the time to do your 2024 tax return, and you probably already have that in 2023, you're going to have a lot of interest income more than before. Because remember, some of our business owners, they set up this SWIP account. Like whenever they have a balance and will go to the saving account, making 4.25%. You know, we have one client that in 1 month, they had about 7,000 interest income out of these SWIP accounts. So with that said, you're going to have quite a bit of interest income. Make sure you know how to deal with it, right? All right. I know I shared the screen with you already. You're looking at our website, communitycpa.com. And folks, you know, this website is really made for you to communicate with us more effectively. And you can go to onboarding with us. And here, if you're not our client, you're thinking of to be our client, but you just couldn't find time to talk to us, you come to here. You come to the onboard with us, you click the button, you set up account on your own, you start to uploading. As soon as you do that, we get an email, we get a notification saying that, hey, someone wants to be your client. Then we immediately get on and talking to you and getting you on board. You can also come to the appointment button to make appointment with us, okay? Obviously, if you're our client, you can pay invoice here, and you also have the client portal that you can log in to see your financial statement, see your related company. If you have 5 companies together, you don't log in 5 times. You log in 1 time, you see all of your business, right? And the payroll portal, that's where you put your payroll, look at your payroll record, employee, and all that. So these are kind of our website is really designed to help you. And our webinars is all deposited right here. Did you see that we have like 1,100 more videos in We have a lot of videos here because we are creating at least 4 videos a week. I do Tuesday, so I do an English one. Then we have the same content repeated for Chinese and Spanish. So when we finish that on Saturday, I bring a large subject over, so we talk about things more. So with that, you got 4 videos each week. We have a lot of videos. And you can see that our topic are very real. They're not so far away from you. You don't know what we're talking about. This is everyday topic that you will get and from a very well educated, very well prepared CPA. And we are the folks that really studies. I like to regard myself as a scholar, even though I talk a lot, but I really do enjoy learning. So I learn, then I digest that into Chinglish for you, then I hear talking to you. So that's our methodology so far. Pretty successful, and we got over almost 6,000 subscribers on our YouTube channel. Now, let's dive into what we want to do today. And here you can actually put in your comments and we will come to you, okay, to answer your question. So let me share our slides with you. By now you know that it's just us, right? We like to do slides only because we want to regulate our content so we can get to the point. Otherwise, if you let me talk for free, I probably will get on to talk about kids because they are just such a bundle of joy when they're little, but they become a bundle of issues when they're old, right? So they're just it's an equivalent for us. So while you have a little ones and you enjoy them. All right, interest income, taxable and non-taxable. Interest income is not always taxable. That means you don't have to pay taxes on interest income in some cases. So let's see why that is. And before I dive into that, I have 3 slides here is related to our firm. You know this elevator speech I always give. I'm telling you that we're not a young firm. We're here for 28 years already. And we're also not a small firm. We have like more than 12,000 clients. We have 40 professionals speak 10 different languages. And we have 5 branches. The newest one is Houston, Texas. Really should open by August 2024 if we can get furniture in. That furniture is a supplier chain broken down. I just can't believe it. It just takes very long to order desks. I am CEO, managing partner for Community CPA. I hope all of you know already. And I actually served on this National Taxpayer Advocacy Panel, which is a federal advisory committee to provide advices to IRS. I served there for 3 years. And then I also want to tell you that I have 2 books on the market. You can buy it from Amazon. And if you just don't have the money to buy it, come to our branches, ask for to ask for autographs. So I'll give you my book. And I'm writing the 3rd one. And you can tell from the time, the 8 a.m., 10 a.m., I'm writing 2 p.m. And hopefully I will finish the 6 p.m. So I got the whole series of business book. With that said, no responsibility for content we have online, and you want to take it with grain and salt, right? Knowing that what you want to know and the things that you are not sure, do your research and make sure you're responsible for what you're learning. Now, let's go. Interest is taxable. Just very simple, straightforward. And interest is taxable, but I want to bring a concept to you called nominee recipient. But let's look at what kind of interest is taxable right here. Interest on bank account, money market account, SWIP account, certificate of deposits, CD. That's what you talked about, CD, right? They always give you a term of how long you have to hold it, right? And of course, deposit insurance dividends. If you don't know what I'm talking about, that just means you don't have it. That's okay. But you know you have an interest from the bank, right? If you are a business owner, you started SUP account in 2023, You know, when you file 2023 taxes, you would get 1099 INT, and that form will give you the interest amount and you need to report it. If you report it on your 1040 and you pay regular tax rate, it's not a capital gain, it is actually regular income tax rate applies to interest. A nominee recipient, I want you to get a concept on this one because we have seen a lot of these happening, especially when sometimes, someone will be saying that, oh yeah, this is my mom's money and I deposited it under my name. It's really not my income, it's my mom's income. That's fine. And you are in the nominee recipient situation. So there are times when you may receive a 1099 for interest from the bank. It's in your name with your social security number on it, but actually belongs to somebody else. So IRS recognize that. They know that happens. So in this case, though, IRS consider you the nominee recipient. If you receive a form 1099 INT or the other form 1099 original interest discount, it stands for OID, that includes a amount you receive as nominee for the real owner. If you are that, then you need to file your Schedule B slightly different. So I'll show you how you're going to do that because that's the step number one. You need to file that in your 1040. No difference from your own, but you do something different in there and you follow up with two more steps to have that interest removed from your taxable income. So that's step number one, is to file a Schedule B under 1040 and put in that interest. It's under your name, so you're going to put that in. And you must then prepare a 1099 INT for the other person. So when you prepare for that, for example, as your mom, then you can get the form 1099 INT. In fact, you can buy that at Staples. Okay, I have seen a lot of them. And in 1 year, I even saw a staple package with all kind of 1099, NEC, MISC, INT, all of these in one bundle was really convenient. It's meant for small users, not some banks have to produce 10,000 of them, right? So you just have one you need to produce. So that is 1099 INT. You need to put your mom's name and the amount and mom's social security number. If she doesn't have a social security number, you can apply for individual tax identification number. It's also called ITIN, right? You can apply for that. Then you got that 1099 INT ready for him, for, but that's not enough. There is another step. You want to file 1096. 1096 is just a summary form for all of your 1099 INT. And you want to, maybe you issue two, so you add two of them together and putting in 1096. So that is your annual summary to IRS. So you want to give the copy of 1099 INT copy B to your mom, and you want to submit copy A 1099 and 1096 to IRS. So that is how you deal with interest. That's not yours, but it's somehow under your name. So that is what, I want to bring that to you because we have a lot of that happen in reality, in real world, and the people don't really know what to do. Oh, it's under my name. What do I do? You can do it. So let me show you on the first step where I said, oh, you're going to put that on the Schedule B and on the line 1. So let me show you. I actually fill it in for you. So let's say $10,000 interest income belongs to my mom. And then I will put in, but it's issued under my name and my social security number. So on my tax return, I will still put in 1099 INT, just like how you are seeing this right here, 10,000. But on the very bottom of the section 1, you see I didn't go out of other places. I stay on the same section 1. I put in nominee recipient. That is me. Okay? And I minus that 10,000. Furthermore, I would recommend you to write bracket and with your mom's name and the IT number or social security number in there so they know that the interest is being run over to a different person. So that is how you can get rid of your taxable interest income that doesn't belong to you. Make sense? All right. So we knew a whole bunch of interest, the interest you normally got, and that's taxable. So you just have to put on the Schedule B, get that taxed. And it is, if your W-2 income is high, then your interest income tax will be high as well, because the interest income is like oil on top of the water. So it will be taxed on a higher rate. Let's look at the interest that is tax exempted. It doesn't pay taxes. The interest that just don't pay taxes. Is there a such thing of I made interest, I don't pay taxes? Of course. So I made a list of the common ones for you. So you keep that in mind, be aware of it, because we don't want you to end up paying taxes on the interest that you received you shouldn't be paying. The number one interest that tax exempt is actually interest from municipal bonds issued by state, city, counties, and the District of Columbia. So remember, these are local government. Local government issue municipal bonds. When they issue that, when they pay you back, that interest you got, it is exempted from interest, from tax. So basically exempted on federal taxes and as well as the state is tax-free. So but you still need to include that on your tax return. And normally you will have a place where you can check mark them to be non-taxable. It is always in any software you use that would give you that choice to ask you, is it taxable or not? Municipal bonds, right? Interest on certain U.S. saving bonds. I gave you an example of Series EE and the Series I saving bond and the education saving bond. Those saving bonds interest is free from taxes. You don't pay federal tax. You also don't pay for the state tax. U.S. Treasury bonds are federally taxable, but state side exempted from the state. You may say that, well, what's the big deal? Because I live in the state, I don't even pay state taxes. Then that's good for you. But most of the state do charge income tax. So if the residents of that state, like Iowa, if you bought U.S. Treasury bond and you will pay taxes on the Schedule B, when that money goes to the state return, you want to uncheck it to make sure that the state doesn't pay taxes. So many mistakes we found. Actually, this particular one, if my memory serves me correct, we saved one taxpayer close to $18,000 on local taxes because it was not taxable at the local, but somehow the tax preparer they had from other firms just forgot about it, didn't really take care of that state. So we came in, amended the state, got their tax free on that interest income. Interest earned from Roth IRA is exempt from tax. That is the whole reason, right? That is the reason why you put in money in Roth IRA, because you put in $10 in Roth IRA, your interest income is $10. You can withdraw the $20 without paying taxes. But if you put that in the traditional IRA, obviously the $20, the interest, the growth part would pay income tax, right? That's why the Roth IRA doesn't really reduce income tax for you when you make a contribution. They want you to make contribution for money that you already paid taxes. You don't get tax saving out of Roth IRA when you contribute, but assume it made money inside of your plan. When you take it out at old age, you would enjoy the free money. So many conditions, right? Old age, make money, and then you can enjoy. So those are harsh conditions. It is, we can never really predict how life goes, but hopefully the peace for human race exists for generations and generations. So we don't have interruptions. Roth IRA can realize its dream. And sometimes you felt like 30 years, 40 years is too far away. And do I really want to do Roth? I hear young people talking about that, and I don't blame them. It is very far away. But Roth IRA, when you withdraw, your interest don't pay taxes. Okay? And the interest on insurance dividends left with Department of Veterans Affairs. So specific. If you are veterans and you have a lot of benefit, this is just one of the benefit. So make sure that you capitalize it, right? Make sure you really utilize it. So you should be putting in savings in that particular kind of account. So getting that dividend out, and which getting that interest out, which is not taxable. And the interest from private activity bonds are not taxable. And you may wonder, what do you mean by private? So the PABs, the private activity bonds, are issued by the state and local government. It's not like we can issue private bonds. No. And that bonds is to provide financing for qualified project like an airport, university, hospital, and the things that offer public benefit, but yet privately driven, like by significant private sector involvement needed. So they call that private activity bonds. These interest free. So if you got interest out of that bond you bought, and it's tax free. And you may just kind of thinking, well, just sounded like a lot of things are tax free when government is involved. And that is so true, because that is the tool the government has on economy, on you and me, right? And to use that tool to maneuver directions where we want the country to go. If we want to increase certain productivities in certain area, and we would give out tax incentives, for example, research and development credit, that is meant for giving to business people, business entity that engaged a lot of research activities where they didn't make money, but it's so good for the public. So they would enjoy that research credit. So the government goes, I give you more credit and do more research, support you, so you don't have to, have too much burden on taxes. So we have a company that is a research heavy a manufacturer. So we have done R&D credit claim for them. We're talking about 150,000 a year in tax credit. That's a lot of credit. That probably means $1.5 million activities, income that doesn't need to go into being taxed, because you have tax credit there to offset the tax. So with that said, it is the government initiative to drive certain activities going forward. By making that happen, they offer incentives, just like the private activity bond, just like the municipal bonds. The local government maybe want to build a school. Maybe the local government want to build the highway. So they do stuff like that, right? So one of the most famous question we got from our client would be, is interest income good or bad? Isn't that $1 million question? So I try to still give an answer. Actually, what do you mean by good or bad? It is just whatever is suitable to you, right? So on the good part, so I use my thought, come up with a good or bad. So on the good part, you have additional passive income. You don't have to think about how your money goes. The sweep account just does the balance for you, make money for you. So you have interest income. So it's nice passive income, right? And the savings, the interest income also means that your wealth grow over the time. And if you can outpacing inflation, then you are ahead of the game, right? And let me just tell you, during the pandemic time, the EIDL loan, what is the rate for that one? 3 point some percent, right? Say, I'm just assuming if you have EIDL loan money that in your hand, today you put that in the bank, you're paying 3% interest on that money because you borrow, right? It's 3% some money, 3% of interest go for 30 years, so you borrow. But do you know what is the saving rate? What is the interest saving rate right now? 5.25? Didn't you just make money out of the money you borrowed? So this is where we say you outpaced the reversal rate. So you come out positive. And if inflation is 3%, then you outpace the inflation. But our inflation rate is high, so the interest rate is high because the economy in the big sense is trying to compensate between inflation and also interest expense or interest income. Financial security, putting funds away is such a good feeling, right? And you have the money putting in the bank account, you have that money there, and it's making 5.25%, not bad at all. And so that's a financial security that you have. So it's good. It's good that you have money to put aside to make interest income. But the bad is the taxation is a thing. You will pay taxes because interest income is an ordinary income, so it has a very high rate if your other income are higher. Not like capital gain, right? Long-term capital gain is 20% top. But no, interest income, the top could be 40%. So yes, taxation is a thing. And the lower return, which cannot outpace inflation, then you actually diminish your own purchase power for the money you save. I remember when I was young, I have an aunt, and I grew up when I was young. I was in China, and so our family don't really have any money, very poor. And my aunt seems to do better, so she saved money. And I know that I have never heard of anybody can save money, but my aunt literally saved 20,000 over the Cultural Revolution time, which is a time that everything is communist, so nobody really saved money. But she saved the money, maybe not in the bank, but she saved the money. By the time when China come around doing this economic reform, and she still have that 20,000. At my childhood time, that 20,000 probably can buy a house if the house is for sale. But by the time the Cultural Revolution is finished, economics start to come around, and then they open the door to the West, whatever the Chinese government did, and that 20,000 is become nothing. So I always felt sorry for my aunt because she saved so hard for $20,000. It worth nothing at the time when she really felt she can spend or she need to spend. So that's the bad part of saving. And of course, I don't know, history would repeat. And I'm in a different place now. Here I'm in US, you are in US. And are we repeating what had happened to other countries at a different time? I don't know. But this is the bad part of the interest. If you save, you're trying to get interest, you can't outpace the inflation, you diminish your purchase power, then you might as well just enjoy life. Buy vodka, drink it instead of having that in your bank and diminishing purchase power, right? So that is good or bad, ugly, but just know you have interest income, then you deal with taxes. If you don't want to pay taxes, you have those limited options to buy that kind of bond, municipal bond, and to earn interest without paying taxes. All right, so much of interest income. Here is the list I was talking about. If you click the appointment button, and all the partners will show up. These are the partners in our firm. And these folks are literally amazing folks. And I know you look at us, feel like we're a young bunch, because if you look at other CPA firm, the seniors are really seniors and they look senior, they act senior. But here in our firm, seniors you cannot tell, and the rest are very young, and we are the kind of energetic, get it done kind of group. So I hope that you enjoy the diversities we have in this partnership. We have people speak all different languages here, and I speak Chinese, and Dan speak Korean. Song, this partner speaks Spanish, and Juan from Thailand so speak Thai, and Derek is also speak Chinese. So we have some diversity. Of course, we all speak English as well. All right. So this is how you relate to us. You can email Catherine at communitycpa.com. Tell her what you want to hear, and then we will prepare. We'll come to you. And you can also call our firm at that number. We open 6 days a week. So if you have not seen any CPA firm open 6 days a week, there, you found one. We are the one. And I hope to see you and enjoy our webinar. I appreciate you are here, and I hope to bring you more and more interesting topic. So hook you up with this site. You can never go away. We love you down. All right. I'll see you again. Bye-bye.